Hi, my name is Yelena Stepanian and I'm going to talk about various asset classes. So what are the asset types or asset classes? First of all, they are tangible and intangible ownerships that can potentially increase in value. In the investment management field, while talking about asset classes, we usually refer to four main asset types: cash, equities, fixed income, and alternatives. In the following slides, I'm going to talk about specific asset classes, some of their main characteristics, and how to own them. This is a more detailed slide on asset classes. Now let's look at each of them in more detail. Cash. As you know, cash is the king. Cash investments are low-risk, short-term investments that offer low return. They are often government-insured up to a certain amount. Your bank account is one of the forms of cash investment. Term deposits. These are instruments provided by financial institutions, for example banks, for a specific period of time. Principal is returned at maturity, but interest can be paid throughout the term of maturity or at maturity. Treasury bills or T-bills are short-term securities issued by governments that mature in 1 year or less. They don't pay interest prior to maturity. Instead, they are sold at discount. Commercial paper usually matures in 1 to 15 days. It is issued by large corporations to get money to meet short-term debt obligations. Money market funds. These are short maturity, high quality money market securities pooled by usually mutual fund companies together for the retail or institutional investors. Next, equities. Equity investments are investments in stocks or shares of publicly traded companies. Your investments can vary in size. Large cap companies usually have market capitalization of more than 10 billion. What's market capitalization? It's the total market value of the company's outstanding shares. So if a company has 3 million shares, each worth $100, the company's market capitalization is 300 million. Small size companies have market cap from 1 to 2 billion. Anything in between is considered mid-size. Style. Some stocks are growth stocks, some are value. Growth are those with earnings growing at above average rate relative to the market. They usually don't pay dividend and reinvest their earnings back into company. Value stocks, in contrast, pay high dividends and usually have lower price to earning ratio. Your investments in equities can vary by geography. They can be domestic, invested in local markets, foreign, or you can invest in emerging markets. And also investments can differ by sector. So there are many sectors, for example, consumer staples, industrials, utilities, where you can invest. Next slide is about fixed income. Fixed income investments are investments that pay fixed rate of return for a specific period of time and are expected to return the principal at maturity or end of period. Government bonds are one example of fixed income. There are nominal and inflation indexed bonds. Interests on nominal bonds don't adjust for inflation, while inflation indexed bonds give investors inflation adjusted return. Bonds can also be issued by different levels of government, by state, by province, by municipality. Corporate bonds are issued by corporations which can also issue convertible bonds or debentures or preferred shares. Investment grade bonds are those issued by corporations whose ratings are BBB minus or higher. So they considered relatively safe companies. Anything starting from BB plus by S&P is considered high yield. So they are sometimes called also junk bonds. Your investments can also vary by geography. Again, they can be invested in local government or foreign or emerging markets, by maturity, long-term, short-term, medium-term, and sector, same way as equities. Next slide is about currencies. Currency investments are investments in foreign currencies. Investors have several reasons for forex, foreign investing, including the anticipation of foreign currency appreciation or matching foreign cash outflows. For example, if you expect euro to appreciate versus US dollars, you buy euros. Or some people just love trading, and forex market is a perfect place since it's open 24 hours a day. Some people have debt in foreign currency, for example, a mortgage, let's say for a villa in southern France. So they have cash outflows in euros and don't want to be a subject of currency exchange risk every time they make a mortgage payment. Currency investments can be direct and indirect. So direct investments is when you actually buy a foreign currency. Indirect investments, assume you have foreign government bonds which earn interest denominated in foreign currency. If the foreign currency goes up, the value of your local, relative to value of your local currency, the earned interest increases when converted back to local currency. And same way you can buy foreign equities, foreign currency denominated equities. Another way, increasing in popularity, is investing in via currency ETFs. They can be investing in single currency or a basket of currencies. So what they do, they replicate currency movements by holding currencies either directly or through currency denominated instruments, usually short-term debt. Next slide is on commodities. Commodity investments are investments in physical commodities or commodity producers. Direct investments include buying directly the commodity or buying futures. Futures contract is an agreement to buy or sell in the future a specific quantity of a commodity at a specific price. Futures are available on most of commodities such as oil, gold, natural gas, agricultural products such as cattle or corn. Or you can get access to commodities through indirect investments by buying stocks or buying mutual funds or commodity ETFs. Next slide is real estate. Real estate investments are investments in various types of properties for cash flow and capital gain purposes, in contrast with primary residence. In direct investment, you buy directly a rental property or a commercial building that was leased to tenants who pay you rent. In indirect investment, you can invest in publicly traded real estate operating companies or in real estate investment trust, which invests in real estate. It's like a mutual fund, but for real estate investments. Or you can buy mortgage-backed securities, such as bonds whose return is secured by the income or mortgage payments from a pool of mortgages owned by large financial institutions or government agencies. Next slide is about private equity and venture capital. These are investments in private companies. What are private companies? They are not listed on public exchanges, and you can't freely buy or sell their shares as you do for public companies. This asset class is primarily used by institutional investors, such as foundations, pension plans, endowments, and some high net worth investors. Private equity investments are investments in mid-size and large companies, while VCs usually invest in early-stage firms. Indirect investment is when you buy a fund of fund, which holds several shares of private partnerships that invest in a variety of private companies. Or now you can also get exposure to private equity through ETFs, which track an index of publicly traded companies whose primary business is direct investment in private equities. Next slide, hedge funds. Hedge funds are private funds that invest in a variety of investment strategies. They are mainly used by institutional and high net worth investors. Some of hedge fund strategies are short selling, when they sell stocks without owning them, hoping to buy them back at a lower price in the future. Event-driven strategy is an anticipation of a specific event that will affect the stock price. For example, merger, acquisition, hostile takeover, or avoiding a bankruptcy. Arbitrage strategy benefits from pricing inefficiencies between related securities, for example, convertible bonds and stock price. You can get access to hedge funds by buying their funds, or you can also buy ETFs which replicate various hedge fund strategies. Investment in infrastructure. Infrastructure investments are investments in large-scale public systems and services, such as highways, bridges, airports, water and sewage facilities, energy distribution systems. They offer reliable long-term cash flow streams. This asset class is primarily used by institutional and high net worth investors. Direct investments are investments straight into infrastructure projects, while indirects are buying mutual fund or ETF with infrastructure holdings or stocks in individual projects. And the last slide is on collectibles. Investments in collectibles are investments in assets that have limited supply, hoping that they will increase in value. These investments offer a growing rarity, which means the demand and price will rise as some items are lost, damaged, or given to museums. These investments have a low correlation with the overall market. That's all for this seminar on asset types. Please check this channel for more investor educational videos. Thank you.